Africa is a continent rich in commodities, resources, and obviously people. It's got the most youthful population on the planet and a growing demand for goods, services, cities, transportation, as well as other large infrastructure. Yet, at the same time, the African Development Bank estimates that the shortage of infrastructure spend on the continent is anywhere between $80 and $140 billion per annum. The African Free Trade Agreement is set in place in order to assist in promoting regional trade. In order for us to sustain economic growth across the continent, we have to be able to grow intra-regional trade, and thus there is huge potential for the Free Trade Agreement to create a mechanism to allow African countries to trade more freely, to allow industrialization in Africa so that we can trade with one another and so that we can offer more efficient ways to export product out of the continent as well as import product into the continent. Our strategy is very clear. We believe that there are two main areas to unlocking economic growth on the continent. One is investment in productive infrastructure, and the second is staying very close to investing in corridors and corridor financing. Any plan for economic recovery requires a substantial investment in transportation and transportation-related infrastructure. There are many great examples of great infrastructure projects and the multiplier effects that they've had on the continent. One that's very close to my heart is the Maputo Corridor. Standard Bank got involved in this project over 20 years ago when we were the only commercial bank who got involved in the expansion of the Maputo Port project, back at a time where volumes at the port were below 10% of their pre-Civil War levels. Investment in the port and the expansion saw a greater demand for cargo in and out of the port. This led to a need to improve the road infrastructure from South Africa to the port of Maputo. When this happened, it became evident that the port offered a shorter route to market for many industries, including agriculture and commodities. What was also created is a flourishing car terminal that allowed a short route to market for manufacturers of vehicles in South Africa to export vehicles via the Maputo port. The biggest point that we'd like to put across, particularly when we talk about corridor financing, is this multiplier effect that infrastructure has. They are all interdependent on each other, yet offer growth opportunity at each point of the value chain. Another great example, and more recent, is the Bike Bridge Border Post project. This is the busiest road border post on the continent and offers a key route to market between the south and the north of Africa. Without efficiency at the border post, we would see trucks waiting 72 hours or longer in order to cross the border. What the project aims to deliver is to be able to efficiently move cargo and trucks across the border within less than 8 hours per vehicle. This is going to be an amazing achievement in as far as efficiency is concerned, and our hope is that we see more border post efficiency projects across the continent. Standard Bank's structure is largely based on creating sectors across its business platforms. Our sector, being energy and infrastructure, is seen as a foundational sector on which other sectors are very dependent. We have deep sectoral experience and have been involved in financing, advising, and funding of a range of infrastructure projects across the continent. The group structures and provides appropriate financial solutions to fund infrastructure projects and provide facilities to entities operating within key infrastructure subsectors. Our aim is to make sure that we've got the right teams on the ground across the continent, the right skills in our businesses, so that we can make sure governments as well as our customers are linked to the right opportunities within the infrastructure sector across the continent. At Standard Bank, we're passionate about Africa and we're passionate about investing in infrastructure. I'm really looking forward to taking this discussion further on the panel to follow.
Good afternoon, and thank you for joining us at this very interesting panel where we will be discussing financing for infrastructure development in Africa and how we can scale private sector investments. As a starting point, please feel free to type in any questions that you might have into the chat box. We will endeavor to answer them along the course of the discussion, and we'll also have an opportunity to have a Q&A session at the end. This afternoon, I am joined by a panel of experts drawn from many different areas of infrastructure development and different organizations. I will give a very quick introduction, and then we can get started with the conversation. We would like to acknowledge Standard Bank's sponsorship of this panel, and we thank Adil Kaji for joining us. He is the head of global infrastructure sector in wholesale banking at Standard Bank Group. We also have Stephen Gray, who is based in Ghana, and he is an accomplished senior manager and also head of expert finance at the West Africa UK Expert Finance Corporation. Mohan Vivekanandan is a member of the DBSA's Group Executive Committee, and he has accountability for Pan-African deal origination and client management. We are also joined by Paul Mojalefa, who is Business Development Specialist with the Expert Credit Insurance Corporation. And finally, we have Jacob Llewellyn, who has more than 15 years of experience in political risk insurance, and he is the Africa Investment Advisor at the DFC. Welcome to you all, and thank you again for joining us. So I'd like to start off by asking Adil to share with us his thoughts around deepening capital markets within Africa, especially given their potential to increase investment in infrastructure in the region.
Thanks, Lade. Yeah, I mean, it's quite common knowledge that robust capital markets, including stock and bond markets, encourage economic growth. We've seen that across the globe. If we think about the context of Africa, the capital markets in Africa skewed very much towards South Africa, Egypt, Morocco, and Nigeria. In fact, at the moment, South Africa represents almost 80% of the region's stock exchange market cap and more than 50% of government and corporate issued bonds. However, I think there's significant potential for African countries to expand their capital markets. And, in my view, there's a couple of measures that could be implemented to boost the continent's capital markets. And I think, a lot of these are not necessarily just in the context of capital markets themselves, but in the context generally about developing the infrastructure landscape on the continent, which, when we think about it in the infrastructure space, is always one of taking long-term decisions. Because of the fact, that the asset classes that we talk about in infrastructure are, often 20, 30, 40-year life assets. And so when we think about measures that need to be put in place, we got to think about them, I guess, in the framework of long-term decision making. I think I'll start with, well-functioning capital markets from a regulatory compliance and risk monitoring system perspective. The empirical evidence shows that well-functioning stock markets, along with well-designed institutions and regulatory systems, fosters economic growth. Improvements in the regulatory framework and economic environments in many African countries have led to improvements in liquidity and capitalization of their stock markets. Together with this, you got to be able to enforce disclosure rules, accounting standards, and general enforceability of contracts in order to improve transparency and boost investor confidence. Transparency is probably one of the top three failures in the success of execution of large-scale infrastructure on the continent, purely because of poor governance generally. Secondly, I think what also has made a difference is increased privatization of state-owned entities, which may be controversial in many respects, but it does provide promise for private equity investment. And it does help with increasing the number of listed shares on exchanges should options of IPO be chosen. thirdly, I would link this to embracing digitization and technology as a general matter. In that, if African stock exchanges and capital markets can promptly adapt to automation and electronic systems, we start minimizing inefficiencies associated with manual systems. We reduce the cost of transacting. We are able to increase trading activity. Automatically, we increase liquidity, and we speed up operations. I think the last point I'll make is, I guess, even from a both private sector and sovereign perspective, is a lot of increased focus on pension fund reforms on the continent. Often investor participation is directly or indirectly through pension plans, insurance policies, mutual funds. But reform for these vehicles will assist in increasing institutional demand for investments and improve saving rates across many regions. And I guess the important point to make here is that typically, outside of DFIs and multilaterals, commercial banks, which is a space that I play in, are not necessarily set up to take such long-term views on infrastructure assets, and so it's the kind of cash flow profile of infrastructure assets typically matches very well the long-term liability profile of pension funds. And so it's really important for us to start mobilizing more and more pension money to get into infrastructure investments on the continent, and more so start thinking about how we mobilize local currency pension funds to start being able to participate more in infrastructure on the continent. I'll pause there. Thanks, Lade.
Thanks a lot, Ada. Those are some great points that you've raised. And Mohan, I want to ask, do you agree? And what role do you see a regional DFI like the DBSA playing in helping to deepen capital markets within the regions for which you are responsible?
Sure. I mean, I think if we take a step back and look at, within infrastructure on the continent, where are the gaps? I think it's widely understood that, there is a significant amount of capital, maybe a little bit less locally, but certainly globally, that's chasing the yields, the consistent returns that you can earn from infrastructure, right? The challenge is, and this is what we hear all the time, where are the projects where this capital can go into? And I think that's the perfect role that the DFI, like the DBSA and others, should be playing, which is really working on the early stages primarily to try and unlock a number of the constraints that are preventing these projects from coming through. So, as an example, what we've done is we've set up a standalone project preparation division that works with both public sponsors and private developers to take projects through that feasibility lifecycle. But if you go even earlier than that, we provide technical assistance support for setting up a program offices, for instance, the Independent Power Producer Program in South Africa, but similar programs in other areas like student housing as well. And even, helping under-resourced government entities with long-term planning to make sure the long-term infrastructure plans are in place. So all of that work that's done in the early stages, I believe is absolutely crucial. It's not enough. And clearly, you need governments to step in as well and provide that, kind of broadly speaking, what's called an investable framework. It covers a lot of different areas, from the long-term plans to pretty transparent processes for how private sector can participate in infrastructure, to the legal framework as well that clears up these issues. But once that's done and you create that framework where there's significant amount of investment opportunities, then we actually find between the commercial banks, DFIs, and various other investors, there's a lot of capital that's looking to invest in the sector. I do think there is a bit more of a gap, especially outside of, let's say, North Africa and Southern Africa. I think there is a gap around local currency availability, especially in longer tenors, to support this. I mean, in South Africa's case, for instance, the DBSA, we can provide 20-year debt for the right types of infrastructure projects. But that tenor of debt is generally not available in local currency in a lot of other countries, even in hard currency for that matter. So, there are some gaps, but I think as a DFI, that's the first place. And then secondarily, in a capital structure, how do we work with commercial banks? How do we work with private investors to extend the tenors, to maybe take the portions that the ECA agencies that are on the call are not able to take? And doing those types of elements also help make these projects more successful. Thank you.
Thank you, Mohan. And I think part of the conversation also needs to think about liquidity, because that's obviously one of the concerns that investors have. They want to be able to exit their investments as needed. And we know that infrastructure as an asset class is not very liquid. So Paul, coming to you, do we need to be thinking about other types of instruments, transaction structures that can really help to drive both investment into infrastructure development, but also thinking more broadly about deepening the capital markets? Do we need to see more bond issuances, for instance?
Thank you very much. Yes, certainly that would help a lot with what we see when we look at the projects we are covering. Our role at the moment is limited to being an insurer, and we will rely on South African financial institutions and developmental finance institutions to do the financing, and then we stand behind them so that we free up their liquidity by getting an insurance cover from us. But we certainly have seen in other continents where project bonds have been issued to fast track those infrastructure projects. As it stands right now, in all the corridors on the continent, the pipeline of projects is very, very long. Unfortunately, many of them are not bankable precisely because they do not meet what many of the financiers would be happy to look into. As a result, we will try our best to work with the financiers and DFIs and commercial banks in general to come into that position and provide the cover, insurance cover, political and commercial risk insurance in some instances, so that some of these projects take place. You have an example which we did recently, which was the railway project in Mozambique, which railway line traverses through Malawi to the port of Nacala. Even though the project is about to be refinanced soon, but it was a situation where now you had a public-private partnership in a way where the private developer developed a railway line, which would also benefit the public in the medium long term. The tenure of that project door-to-door was 18 years. And the banks took comfort that we can provide cover for that, even though now, of course, it's coming up for refinancing. So we certainly think that there could be more if people can approach the export credit agencies through their financiers. And we would have a suite of products which we are working with to make sure that some of those projects really get to financial close, because the problem is the pipeline of projects that need to fill the gap of infrastructure development on the continent is quite big as we speak. So I will pause there for now.
Thank you so much, Paul. So it's clear from what both you and Mohan have shared that the issue is really not the capital. I think this is a well-known fact, and it's really the quality of the pipeline, and we need to deepen that pipeline to get more bankable projects to market. I want to shift a little bit to talk about funding models. Somebody talked about PPPs. So that is one approach to financing infrastructure on the continent. We have seen mixed results with public-private partnerships. We've also seen other types of funding models being deployed for infrastructure development. What's missing? So Jacob, I'd like to get your perspective. What else can we be structuring to get more infrastructure projects to completion?
Sure. Thank you, Lade. So I think a lot of it comes down, particularly from a DFI perspective, to governments and their institutional partners continuing to take action to improve the commercial viability of projects. And this can include things like helping to mitigate the political, currency, and regulatory risks, and to thereby increase the deal flow for bankable projects. This, as you suggest, this could either be under the PPP model or simply a matter of influencing things such that there's as much private sector investment as possible. As all of us, on the panel have likely observed, the private sector will only get involved in projects, with predictable and stable returns that are adequate relative to the risk involved. So I think it's important that with the assistance of the World Bank and other development agencies, governments continue to strengthen the business climate to lower project, macroeconomic, and exit risks, which are three key concerns for investors. A second step that various African governments could consider is to reallocate government financing in line with international best practice. In other words, to prevent the crowding out of private sector finance in certain areas, governments could consider reallocating financing from the most commercially viable asset classes to those that provide lower returns, such as water, sanitation, and transport, which are typically more appropriate for government investment and more challenging for strictly private sector involvement.
I think you raise a very important point, but I'm not sure how much political will necessarily there is, and even within the various types of financial institutions that we have represented, there's sometimes criticisms around whether or not even DFIs are crowding out the private sector. I'd like to come to you, Stephen, to get your thoughts on this. And as an expert credit agency, where do you see your role, and what other types of funding models do you think are worth highlighting?
Adi, thanks for that. But I'll just quickly go back to that comment about the DFIs. I shared that view, as you just articulated, that there was little space between commercial banks and DFIs. But I think in the last 18 months with the pandemic, there has been a growing gap between the roles and the capabilities and the relevance of DFIs and commercial banks, to the extent we've seen commercial banks pulling out of the markets because of the political risk insurance isn't available from the private market, and yet the DFIs have remained in place. So their role, I think, has become enhanced as a consequence of the pandemic. But in terms of export credit agencies, we are counter-cyclical in terms of demand for our work. And that's been very clearly demonstrated by the load of work that we've covered as UK Export Finance in the last year, where the number of transactions that we have supported have tripled in the last year, because people are looking for the quality of the guarantee that's sitting behind a transaction. And with that quality of guarantee, the governments are then able to break the sovereign ceilings and access capital at a much lower rate than they can get themselves on the Eurobond markets. And so you see the flow of preference of funding models is one, go to concessional finance, which I think talks into those projects that Jacob was talking about in the water, the sanitation, that has little commercial return but has real economic and social impacts. You then go into the ECA markets, which are slightly more expensive than the concessional, and then finally you go into the commercial markets, which is either banks or the bond markets, and each have their own different profiles. And with that, you can blend those parts. So ECA is very much relevant. The challenge that we see with sovereign deals at the moment is the tightening of the fiscal space that governments have faced as a consequence of the last year, and ensuring that the transactions that we support are sustainable from a debt perspective. And I think that's the real challenge as we move forward, is governments accepting new models to leverage in private sector finance in a way and with models that perhaps they were less comfortable with in the past.
Thank you, Stephen. Very, very important points that you've raised there. And I want to come back to that earlier comment and also just give Jacob the opportunity to tell us why it was important for the U.S. to restructure its DFI. So shifting from OPIC to the new DFC, which also houses the Foreign Development Credit Authority. So speak to us about, that shift and how that ultimately is also going to support greater investments in infrastructure, And also to that earlier comment about DFIs potentially crowding out the private sector, what measures are you taking to ensure that you are not playing in that role?
Sure, absolutely. Thank you, Lade. So as you mentioned, DFC has been in existence just since January of last year. It is the U.S. Development Bank after having incorporated the old Development Credit Authority of USAID into our predecessor agency, which was OPIC. And all of that was done as a result of a bipartisan bill, specifically the BUILD Act. So DFC at present offers debt financing, partial credit guarantees, political risk insurance, as well as direct equity and funding for investment funds. And in all of these cases, we partner with private project sponsors. We're only able to support projects that are majority owned by the private sector. One major difference from OPIC, folks may recall the prior kind of U.S. nexus requirement that was principally fulfilled through U.S. equity in the project company. That's merely a preference, and for the most part, it really just comes into play when we support projects in upper middle income countries such as South Africa. Another significant difference is that we now have double the amount of capital to deploy. So it's $60 billion as opposed to $30 billion. We have at present about $8 billion in active commitments in Africa, spread across about 300 transactions. The team that I'm a part of, there are 6 of us based in different cities on the African continent, has as its mission essentially assisting in terms of doubling the amount of commitments that the DFC has in Africa to $16 billion in total over the next 5 years, including through an increased focus on lower and lower middle income countries. Many of the transactions that we've had in the last year, as well as going forward, are expected to be in climate resilient infrastructure based on some of the objectives of the new administration in the States, as well as healthcare, food security, ICT, and women's empowerment. To address another part of your question, in terms of our development strategy, DFC has agreed to invest in technology, including ICT and infrastructure projects, in order to spur economic growth through increased trade and regional connectivity, for example, roads, bridges, and ports, as well as infrastructure projects that provide basic needs, such as housing, hospitals, etc. We've pledged to make $5 billion in technology and critical infrastructure investments over the next 5 years. This is meant to expand logistics, warehousing, and transportation infrastructure in order to increase regional and global connectivity through 10 major infrastructure projects, LICs or LIMICs, lower income or lower middle income countries, as well as fragile states. We've also set a goal of increasing internet access for 3 million people. Likewise, it's our objective to commit $10 billion in energy sector investments, increasing the country and regional energy security through diversified domestic power generation in 10 countries. When it comes to energy, our bottom line goal is to increase electricity access for at least 10 million people by 2025. And all of this is memorialized in our roadmap for impact, the inaugural version, which was released in approximately November of last year. To then go to the other part of your question in terms of competition, for any project that we seek, that we look at supporting, we have to essentially go through our process in terms of confirming that it's additional, that we're not at all crowding out any of the commercial banks, and instead, that we're acting in consort with them. Many times, that occurs in terms of being able to lengthen tenors, as I think one of my colleagues alluded to, or by some of the other structures enabling, financing to take place with more realistic collateral requirements, based on the status of a small business, for example, or SME.
Thank you, Jacob. Mohan, I want to throw the same question at you and also introduce the structuring approach that a lot of people are now talking about, which is blended finance, and really the role that DFIs can play to attract and mobilize private investment. But there's always still a little bit of that tension between how much risk you're able to take without impacting your own credit rating as a DFI. So Mohan, what are your thoughts around this, and how are you seeing blended finance helping to increase investment into infrastructure?
Yeah, sure. I mean, I think, there's a couple of different topics at hand. One is this issue of crowding out commercial investors. The reality is, I think at a certain price, there's always somebody who's going to pay, give you the money, right? So for instance, in South Africa, we use the term mashonisas, meaning these, if there are private credit providers who, and I know I've been speaking to many of them, they'll charge you 18, 20% in dollar rates for, 5-7 year tenor, basically mezzanine subordinated debt. I'm sure Adil's, bank will also provide that for you at, for certain types. So the point being, if we're talking about critical infrastructure that the country or the continent needs, what's the role that we as a DFI can play in making sure there's, capital coming in, one, taking the right tranches, but also, ultimately making it affordable. Because remember, somebody has to pay for this back, and that somebody is either, individuals that are the users of electricity or toll roads, or, the general people that pay taxes, right? Because the countries have to repay those Eurobonds or whatever uses are made for this. So, I get the comment about not wanting to, crowd out the private sector, and clearly, we work closely with them. But, I think arguably there'll always be somebody who will provide you with that capital. You may not want it though, at those rates and terms. So that's the one thing to keep in mind. The other is, in practice, how does it work, and how do we use blending as well? One example of how we've been able to do it is the DBSA is accredited to the Green Climate Fund and the Global Environmental Facility. And we've been able to use that accreditation to promote climate finance, especially for private sector borrowers, and now secondarily for embedded generation for any sub-sovereign borrower in South Africa as well. And the goal there is it's a facility that will work with commercial banks. The commercial, so you've got a private sponsor generally who's going to provide a tranche of equity, let's say 25%. You've got commercial banks providing another tranche of, let's say, short to medium tenor debt. And then you've got the DBSA and the facility from the Green Climate Fund that can provide 15-year tenor for private offtake. Now, that level of tenor, if you're lending to a mining company, as an example, rightly, a lot of commercial banks are not willing to provide that level of tenor. So it's an opportunity, but the asset itself does have that kind of a life cycle if you're talking about a renewable energy asset. So it's a good way where, we ourselves, working with the Green Climate Fund that's providing highly concessional loans, can combine that, bring it in with, loans from commercial banks and working with private equity sponsors as well to make, that project more viable. Would that project have been viable anyway? Possibly, but you may have had to charge an extra 1-2 US cents a kilowatt hour, in terms of a tariff. And by bringing this in, you can bring down that tariff. Now, if it's a mining company, you may argue, well, who cares if they have to pay an extra cent or two? But, if it's your taxpayers, it does make a difference, especially when you're talking about poor working class taxpayers, who have to cover those rates. So, those are ways tangibly of how we can create structures, bringing in blended finance, to make these projects work. And we've done similar projects. There's a hydro project we're looking at in Central Africa where there are different tranches from different types of providers. You've got a more global multilateral development banks that are able to open up much longer tenors and at highly concessional rates. The DBSA comes in with what we think is an adequate return. And then you've even got, a private credit provider, effectively a private equity company, but on the credit side, who's also providing, debt into that structure as well. So those are different ways that we work together to make these projects work.
Excellent. And Adil, do you agree? As a commercial bank, are they bringing good deals to the table, and how involved is Standard Bank in some of these projects that utilize blended finance for risk mitigation?
Yeah, I would definitely tend to agree. I think, maybe, and people have alluded to it in the past few minutes as well. So we constantly speak about there being no shortage of a pipeline of projects on the continent, but there being this massive shortage of bankable projects. And so I think, in many respects, this whole issue of, who's being crowded out and who's being left out and who's being pushed out is really, a function of the fact that actually, when it comes to large scale bankable projects, there are only so many that appear on the continent. And so everybody who's got any capital wants to, find a way to participate. And very often, we find certain institutions getting the bulk of it. Obviously, that comes down to price and risk appetite, etc., and others feeling like they got pushed out. And so I think fundamentally, it goes back to some of the key kind of infrastructure development issues on the continent. The first being that we don't necessarily have, and this goes for, I guess probably every country that we have presence in on the continent. We don't necessarily have good long-term planning frameworks around which infrastructure planning is done, and that provides a number of things. One is it gives everyone that sort of comfort and visibility around long-term infrastructure planning, which goes beyond political term. And it's another disadvantage, I guess, because infrastructure development in its essence is so intrinsically linked to government and sovereign decisions, is that very often, you need to be planning for 20, 30, 50 years, but decision makers are taking decisions in 5-year terms. And so there's this ongoing conflict that we experience on the continent, and I guess it happens globally. But this concept of a long-term planning framework, I think, is key, number one. Number two is, in order to deal with the issue of bankability, is really for governments to get better at project planning and project preparation. And I think, I know the DBSA is very involved in that aspect in terms of supporting government and government institutions around getting better at project development and project preparation, so that when these projects do come to market, a lot of them are in much better shape in as far as private sector definition of bankability is concerned. So that kind of deals with the background. In terms of blended financing, yes. I mean, ourselves have been very much involved in a number of projects across the continent, not only working, side by side with developmental and multilateral agencies, but also working directly with governments, where governments have sourced, G2G concessional loans for pieces of infrastructure, where we found ways that we could participate. And I guess as a commercial bank operating in the sector, it's not always necessarily about direct lending to a project to make a project work, because from our lens, we are a commercial institution. We have a commercial customer base that operates on the continent, and in many instances, these are long-term investors in the sector who are looking to grow their own businesses on the continent. So, EPCs, cement companies, construction companies, transport operators, all of these guys operate within the sector. And so if we find ways of supporting them in their chosen jurisdictions, indirectly, we are often involved in infrastructure development at project level. Secondly, the idea of better collaboration and partnership on the financing side, I think, is something that's becoming a lot more of an open topic as between, and I speak from my own personal experience, as between us as commercial banks, together with the likes of DFIs and multilaterals, where the conversations are a lot more about, well, how do we do this together, rather than having discussions about, well, we feel crowded out, or, we can't match pricing, and I don't think, I do remember, 5 to 8 years back working with DFIs, kind of seeing them as competitors to a transaction, whereas over the past 24 months or so, rather seeing it as, okay, well, how do we complement each other in as far as what our strengths are? And so there are many examples in our own portfolio around where, we would be able to deal with a lot of the upfront heavy lifting in as far as modeling and due diligence and structuring is concerned, and look to partner with the DFI where we take kind of shorter dated risk and tranche the debt in such a way where we could allow ourselves out as commercial banks in a shorter period of time, and leaving the bulk of the back end risk to the DFI, and not necessarily just tranching, but actually back ending, allowing the DFI to actually back end or most of their debt while allowing us to get out first. And we've done this successfully on a number of transactions over the past 24 months.
So what you're saying is that there's greater collaboration between the commercial banks and the DFIs, and that ultimately is helping to get more projects done. That's really good news to hear, and we'd love to see more of that.
I think so. I think so. I think Stephen made the comment earlier, just in terms of it seems that over the past 18 to 24 months, given what has happened, roles have by default become a little bit more defined. And I think that, what we're seeing is a function of that definition of roles, making it easier for us all to understand, okay, well, this is my role and this is how I better collaborate. Because at the end of the day, I think it's also become clear that the pie is big enough for everybody, provided that we find better ways to collaborate and partner.
Fantastic. And so coming to Stephen and Paul, so what is the role of export credit agencies, especially when we're talking about crowding in private investment and also getting more projects done? Stephen, Paul?
Some interesting points raised there. And from an export credit agency perspective, when it comes to local currency, as UK Export Finance, we can provide guarantees in local currency. And then across the continent, we can do 16 African currencies, from the CFA, South African Rand, Pula, CD, Naira, etc. What we've seen in that space is the challenges, as Mohan and Adil talked about earlier, about the tenors that the commercial banks are willing to lend in that space. And there are opportunities, and certainly we've had some discussions with some of the capital market players, the insurance companies that have the appetite for that, matching their longer term liabilities with longer term revenues, where they could come in and use the guarantees that we are offering in local currency to provide longer term paper that are aligned with the OECD common arrangements. Typical infrastructure projects, it's up to 4 years moratorium plus 10 years repayment. It'd be very difficult to get a commercial bank to provide that sort of tenor. But the capital market players could now come into that space with the quality of a credit guarantee that takes away a lot of this sort of front end risk that those type of investors typically will not take on. So that's one example of where the ECAs are able to leverage in private sector investors into this space.
Paul?
So for us as ECIC, it's really to echo what Stephen has now just put forth. We provide commercial and political risk insurance, which is meant to facilitate the export trade and cross-border investments. Our role as ECIC, of course, is to also unlock the availability of that finance for those buyers in the infrastructure space of these South African exporters and contractors, goods and related services. As I mentioned, we do not really provide direct lending. We rely on the close collaboration we already have with commercial banks, DFIs, and other institutional investments. That role, to echo what Stephen has said, is to really mitigate the risk, which reduces the net exposure in the event of loss for the lender that has provided the lending to the project. And, as I mentioned earlier, the lenders then get capital relief for the exposures that we are covering on their behalf. And we have seen many times that benefit and that risk transfer then result in a lower margin that is charged to the borrower. And for the loans that we provide cover on, it's really 100% political risk cover and up to 95% commercial risk cover. At the moment, we are limited to providing cover in South African rand and US dollar. There are measures afoot to also provide cover in euro-denominated transactions. They will also be announced, and some of them have come through the press, that we will also expand our mandate in what we provide the cover on. It was just capital goods, but some of these infrastructure projects don't qualify because the exports from South Africa are not necessarily capital goods in nature. So we are expanding our mandate, and we really have a bigger role, we believe, to play in the infrastructure development on the continent.
And as ECAs, Paul and Stephen still, are you satisfied with the number and the quality of projects that are coming to you? We've talked about this, I think at various stages of this conversation, that there is work that needs to be done to improve the quality of transactions, but also just the commercial viability. So what are you seeing on your end? Because you're further down in the value chain, if you will.
So from a UK sport finance perspective, across the continent, probably about 70% of the transactions we do by value are in the infrastructure space. And they are typically sovereign deals, given the approach that many sovereigns take in terms of their the way they see their responsibilities in delivering infrastructure. The quality of the deals that we have come through, generally very, very good in terms of the economic impact, how they fit within the sustainable lending requirements that we have to follow. The challenge often is the capacity, the fiscal space of sovereigns to be able to fund those at the time that they want to, based on a sovereign purchase rather than a PFI, PPP type model. And we know the history around PPPs and the challenges that many projects have faced in that space. So I think quality of opportunities, always there. It's about fiscal space for governments. And when it comes to the private sector, one thing that perhaps the World Bank don't get enough recognition for is the thought leadership impact that they have. If you look at the growth of PPPs in Africa, it started off with the port sector, and that was generated by a lot of work that the World Bank did in terms of what is a PPP model for port operators, port owners, landlord models in the continent. That thought leadership process then went into the power sector. I would really look forward to seeing the World Bank doing more work around this thought leadership on PPP models into other sectors, be it water, sanitation, climate adaptation, climate resilience.
Yeah, for us, it's a mixed bag. Some of the infrastructure projects we see do come and they have quality and they are able to move. There are instances where some of them are behind in where they need to get to. And we have now found value with our partnership with the DBSA to then forward some of them for the DBSA in terms of the project preparation funding to then help them shape what they need to do to get this project quickly to a state where the lenders can come in. So it's not really all lost because we can see the value in some of these projects and we then marshal them into the right direction. And that seems to be working, even though it's taking time, but we are slowly working towards making sure that the sponsors that bring projects are of a quality and a bankability level to attract funding going forward.
Sorry, can I just come back in on that, Paul? The bankability stage and the funding of that is an area that's of particular interest to me. And the challenge is, you've got $180 billion a year required for infrastructure on the continent. To be able to fund the project preparation, it's about 5% of that value, $9 billion a year. Neither the sovereigns nor the DFIs have that sort of money available to fund the flow of infrastructure required. And so we really do need to find risk mitigant instruments to be able to leverage in the private sector where the full value is. Because one of the biggest challenges in the project preparation space, as alluded earlier, is the time consistency of stakeholders and the risk associated with that, where politicians are working on a 4 or 5 year cycle, but sometimes to get a PPP project across the line may take longer to structure it. And so you see decisions being made based on expediency, not on robustness of delivery.
Thank you for that, Stephen. And that's a really good segue into the next question that I wanted to throw to everyone on the panel, which is who's missing from this conversation? National development banks, local currency financing. There's a huge gap and a huge opportunity there. And also thinking about pulling in domestic institutional capital in local currency to finance infrastructure. So how do we get them more engaged? And potentially, is there a role for national development banks to help with project preparation and mitigating that early stage risk? I'm going to start off with Stephen and open it up to the other panelists to comment.
So I would say one key stakeholder that's missing from the table at the moment is the sovereign wealth funds, and if you look at some of the examples in West Africa, you've got the Ghana Infrastructure Investment Funds. In Nigeria, the Nigerian Sovereign Investment Authority. Those guys are doing some really amazing work in project preparation space, and the value that they have for an external investor is that they give a level of halo protection from the political risk in a way that, MEGA can provide that, but they're in the rooms that can then communicate back saying, this project is real, this one will get the support needed to get across the line. And so I would really like to see the sovereign wealth funds who are now starting to pivot their investment focus back into their countries to support that tightening of fiscal space.
Jacob, do you want to share your thoughts on this?
Of course, sure. Thank you. I also feel, as Stephen does, that sovereign wealth funds are a resource that should be tapped more. I know that Mozambique, for example, is in the process of setting one up. You mentioned, national development banks. Thankfully, we have the representation here by Mohan for DBSA. DFC seeks to work as much as possible with the national development banks. I would say, when it comes to local financial institutions, as a result of the legacy product, that we took on board through essentially the merger that created DFC, is an ongoing tool that we have to provide. In other words, partial credit guarantees to local financial institutions. We can provide, these local portfolio guarantees of up to $1 billion and for tenors of up to 25 years. It's an instrument that provides comprehensive cover for debt, but there's risk sharing, typically around 50%. By way of example, we provided a guarantee for the Court Aid Foundation, and this was done in tandem with USAID, which provided some grant resources. So this went to small and medium enterprises in Burkina Faso, as well as Guinea, Mali, and Sierra Leone. The program is expected to support at least $37 million in terms of loans to 50 SMEs, as well as 8 microfinance institutions by 2025. The transaction utilizes a blended finance model, including first loss capital provided by USAID. The guarantees can potentially qualify as capital relief, depending on the structure and the relevant regulations for the applicable countries. One other tool that we have, in addition to the partial credit guarantees, is that in a couple of instances in Africa, as well as other developing markets, we've provided tier 2 loans to different regional DFIs or regional financial institutions. Most recently for Africa, this was one to the AFC, Africa Finance Corporation, based in Nigeria, which has a focus on hard infrastructure. We also have another tier 2 loan in the pipeline for another African financial institution. We don't ourselves do, or we haven't, I should say, thus far done local currency lending, although we now have the authority for it, and we're looking into the mechanics of that for projects in Africa.
Thank you. Mohan?
Yeah, I think national development banks do have, quite an important role to play, but it's not always going to be the same role that we think about, and because it's really going to depend on the country and the capability of the National Development Bank, let's say that's involved in infrastructure in that country. So, there was a Fitch report that was recently launched around a resurgence of national development banks on the African continent. But if you think about them, what if they rated them, there were 2 or 3 entities from South Africa, one from Morocco in sort of the first tier, and then a couple of others, including one from Namibia in the second tier. But the reality is a lot of the national development banks don't really have the balance sheet to be able to play the real heavy lifting that's needed for infrastructure. But the role that they can play is because they are, local entities, they typically report into the finance ministries. They have the ability to play a good, honest broker role in the country to help work with government to define the priorities and bring in other financing entities, whether it's bigger, development banks like the DBSA or the DFC, or commercial banks, like Standard Bank, or, working with ECAs as well, like Stephen and Paul's, to bring in a mix. Now, they may not always have that capacity, but what we've done as DBSA, as an example, is, we're part of a group of Southern African DFIs. Funny enough, there's 40 of us, if you believe it or not, in just this group of 16 countries in the SADC region. And we work together to try and see how we can finance the SDGs on a common basis. In fact, the discussion we're going to be having later this month for the CEOs is focused on resource mobilization, because many of them don't have the balance sheet, they don't have the ability to tap into global DFIs, into capital markets. So we need to keep finding ways to help them as well, because they know the priority projects, and having them on the ground involved in these projects is really a form of risk mitigation as well. So for us, it's about how do we work creatively with those entities to have them have some skin in the game, help us prioritize projects in their countries, and then we try and bring in the capital and support them. And so that's one of the ways. And if we think about it, all these countries signed up to this in the Addis Ababa Action Agenda. There's a specific chapter on that about working with local entities. And yet what's happening is, the global DFIs, the MDBs just go in and do this. They're not working with the local development banks. And I think it's really a missed opportunity.
Thank you, Mohan. Adil, what are your thoughts as a commercial bank?
I would definitely echo a number of comments that have been made already, but not to repeat anyone else's ideas. I think obviously we operate local banks in over 20 geographies on the continent that we're present in, and our challenges are similar. And so I would agree, definitely, national development banks have a big role to play. Sovereign wealth funds are missing from this discussion. The other piece that I think is something that we've been seeing in some jurisdictions that really makes a big difference in terms of unlocking participation of local institutions, but also unlocking the right type of infrastructure projects is actually having policymakers at the table, and policymakers a lot closer to private sector thinking around infrastructure development. So, it's one thing having political or governmental institutions talking about crowding in private sector, but it's another thing having active collaboration with public sector institutions in terms of planning execution. And I think that's made a very big difference. And I'd use South Africa as an example, particularly over the past 18 months, having a lot closer relationship directly with public sector institutions around how we work together to solve problems. And we've seen this, repeat itself in some of our geographies in East Africa as well, where, we understand what the challenges are around delivering certain types of infrastructure, but because of a really close collaborative attitude as between public sector and private sector, we're able to find solutions a lot quicker. And we've mentioned it a number of times over this discussion is, one of the big hindrances to any development is time. Given the long-dated nature of these projects in terms of planning, preparation, incubation, and execution, often getting close to a decade for a single project, it's imperative that we do find ways to better collaborate with public sector in order to compress timelines. So my major point would be being able to compress timelines to foster better use for local currency institutions.
Thank you, Adil. Some very salient points that you've raised there. I'd like to come to Paul. Oh, somebody wanted to jump in?
Yeah, I just wanted to make one comment because you'd asked the question about who's missing as well. And I think that, unfortunately, I'm part of the problem here in the sense we don't have enough private sector voices, especially on the equity side speaking. I think there has been a lot of new, private equity players entering the African infrastructure space from Europe, a little bit less from the US. Even today, if you looked at the announcement in South Africa about SAA and the privatization, a portion of it's being played by a private equity entity as well that's stepping into the breach. So, I think those entities, and they're effectively the arm of institutional investors, right? Because it's the institutional investors that are capitalizing them and allowing them to play the role that they're doing. They play an absolutely critical role as an equity investor, getting stuck in early, trying to unlock projects, because all of us are ultimately enablers of those entities as the sponsors. So I think, we really need to see more of them coming in, and hopefully, the institutional investors will support the creation of more of those private equity entities, especially local private equity entities who can step in and play that leading role in the early stages. I think that would be critical for infrastructure moving forward.
And that's a very important point. And I think a healthy risk appetite as well to go alongside that. So Paul, I'd like to bring you in as well. Who's missing from this conversation?
In a way, I echo what has been said before me, that one of the things you see, the mixed bag of success on public-private partnerships, is that the enabling legislation in some of the jurisdictions is now making those PPPs not to be a success. And then in other places, it has become a success. So what it means is that the policymakers, as was mentioned earlier, is what needs to happen for them to actively come to the party to make some of these projects to work. Indeed, local currency funding in some instances has proven these days to become a very big tool to mitigate some of the risks that foreign investors may be worried about. And if we can really, even for ECIC, we still are grappling with that to say, how do we mobilize those local currency funding in the syndication of loans so that these projects can really become bankable and then allow other players in the market, the home market, to also come in and play. So I think that for me is what we see as now an important element to then bring some of those even more closer into the deals to make them a success.
Thank you so much. So some of the common threads that we've heard repeatedly in various forms throughout this very engaging conversation. One, the importance of understanding the various roles and responsibilities played by the various actors, even those represented in this panel discussion. And we're also seeing a lot more collaboration. Certainly the pandemic has facilitated that, but we hope that in the longer term that we will continue to see collaboration between concessional capital providers, providing risk mitigation, but also catalyzing more commercial investment from the private sector, and also including local currency solutions from local institutions, national development banks, sovereign wealth funds, pension funds, insurance companies. There's a role for everyone to play in increasing investment and getting more infrastructure projects to commercial operation. So as we wrap up, I'd like to give each panelist 60 seconds to give us a parting shot. What is one thing that you want the audience to walk away with this afternoon? Paul, do you want to start?
Okay, so I would say that export credit agencies do have a role to play in infrastructure development on the continent. And we would like the audience to know that with our strong footprint, we are an invaluable strategic partner in doing business in Africa. We have strong economic ties on the continent, through our bilateral relations, which helps us a lot in being instrumental to support the wide variety of infrastructure transactions across the continent with our 20-year track record. And we do use our advocacy work if ever there are claims that they can come for the lenders and DFIs that we cover. And we do pay claims on time, and we still continue to do so. So in essence, for ECIC, we are a partner that is important to make sure that as an ECA, we can make many of the projects to work.
Thank you. Stephen.
So UK Export Finance is open for business in Africa. We have 4 people on the ground across the continent, and so we can help you succeed. And by partnering together, we can pool our collective ambitions and seize the opportunities so that together we can build a stronger, brighter, and greener Africa.
Thank you. Jacob.
Sure, thank you. I would just highlight 2 quick things. One is DFI collaboration, which is quite important to DFC. We signed a joint communique with various African DFIs last October. It's also the same approach that we've taken recently to some vaccine manufacturing deals, which are at an advanced stage and will come out publicly in the near future. I would also state that, in part what the DFC also represents is more collaboration within the US government. So many of you are probably familiar with the Power Africa initiative with regards to the energy sector. There's also Prosper Africa, bringing together about 17 different US government agencies. So a lot of our discussion today touched on project preparation. We work closely with USTDA, the Trade and Development Agency, in terms of that. One tool that DFC now has is technical development as well, but that's largely just the final stages of making a project bankable or increasing the development impact. And it's done on a reimbursable grant basis, repayable to DFC shortly after financial close.
Thank you. Mohan.
Yeah, I think it's a very exciting time in African infrastructure. The continent spending about $100 billion per annum in infrastructure, according to the ICA, but really that's about 3.5% of GDP, and we really need to double that, I would think. And so there's a significant opportunity. But even if you just look at where I'm from in Johannesburg in South Africa, there's significant movements, especially in the energy sector, but even in other sectors, transport, water as well, where I think the government's moving in the right direction, setting up the infrastructure fund that the DBSA is managing and working closely with the presidency on. So there's significant opportunities in a lot of these sectors. I think, if I was a private investor, I'd be very excited about it. I would definitely encourage them to call the DBSA, call the export credit agencies as well, and see how we can work together to unlock the markets. We as a DFI are doing some of the early stage activities to do just that, working with our national development banking partners on the continent. But we stand ready to work with all the parties here. In fact, I think we've done deals with every single one of them or are in discussions with them. So, we're quite excited about the opportunities. Thank you.
Excellent. And Adil, the final word.
I think, African governments are seeing post-pandemic recovery, and the way to get there are seeing infrastructure as the key, and infrastructure investment is the key to post-pandemic recovery. And so, on the flip side of that coin, we all know Africa remains a continent rich in resource, rich in commodity, with the largest youthful population on the planet, who have demands for goods and services that we are committed to deliver into. So at least from Standard Bank's perspective, with a wide sub-Saharan Africa presence and infrastructure investment as core to our business strategy, remaining true to our tagline, Africa is our home, we drive her growth. So very exciting times ahead.
Wonderful. Thank you so much. And on that note, I would like to thank the audience for their attention, participation, and all of the great questions that have come in. Would also like to thank Standard Bank again for providing this platform for us to engage in this very stimulating conversation this afternoon. And I would also like to end with thanking the panelists, Adil Kaji, Jacob Llewellyn, Stephen Gray, Paul Mojalefa, and Mohan Vivekanandan for your time and your great insights. I hope you have a great rest of the afternoon. Thank you.
Thank you, Lade.
Thank you very much. Thanks, Lade. Well done. Cheers.